In terms of scheduled news, we have one of the quieter weeks of the year coming up, but trade, tariffs, and the seemingly inexorable rise in US Treasury or government bond yields will no doubt still give us all much to ponder. The latest UK unemployment and wage growth data on Tuesday the 10th of June will also be worthy of note, as may the following company full year, first half or trading statements. First Group, Safestore, GB Group and Oxford Instruments on Tuesday the 10th. Fuller Smith & Turner, VP and Malton Ventures on the 11th. And Norcross, Crest Nicholson and Idox on the 12th. Now that said, 3 more corporate updates could write plenty of headlines in the coming week, and they're due from Bellway, Tesco and Halma. Shares in house builder Bellway are marginally higher than a year ago, but still 1/3 below their pre-COVID peak, as issues such as housing affordability and planning regulations linger, and doubts rise again over the rate at which interest rates and by extension mortgage rates may fall. This will be a third quarter trading update for the 9 months to March from the house builder, and it's due on the 10th of June. We won't get a full profit and loss account, cash flow or balance sheet, so the statement will be judged against the 3 key targets for the full year to June provided by Chief Executive Jason Honeyman at the time of March's first half figures, when sales rose by 1/8, pre-tax profit by 1/5 and the dividend by 1/3. So first up is an increase in completions of more than 10% to at least 8,500, with a broadly flat average selling price of around £310,000. An increase in the order book to set out Bellway's stall for growth in the new financial year. As of December, the order book was 5,600 homes with a value of £1.6 billion. Watch out for any comments on reservation rates. In the first half, this was 0.51 per outlet per week, up from 0.43 in the same period a year ago. Both data points there will give a feel for visibility of demand and earnings going forward. And finally, an increase in the full year operating margin to 11% from 10%. Keep an eye open for comments on input and cost inflation, any more provisions for tall and legacy building project remediation, where Bellway booked another 9 million or so in the first half. Add all of that lot up and the current analyst consensus for pre-tax profits 267 million, up from 184 million in the year to June 24, with a hike in the dividend per share to 64.7p from 54p a share. Tesco's first quarter update is due on Thursday the 12th, and the headline figures will be the like-for-like change in sales, excluding VAT and fuel, at the UK, Irish and Booker businesses, as well as the Central European operation. Only Booker suffered a drop in the financial year to February 2025, and the latest market share figures from Kantar for the UK grocery market seem to bode well, as Tesco has gained 40 basis points, or 0.4%, of market share over the past year. That may help to explain why Tesco shares aren't far away from a 12-year high, despite fears of a supermarket price war. Chief Executive Ken Murphy gave a cautious outlook for the year to February 2026, and the other key feature of this update will be whether he makes any changes to that. Remember, Mr Murphy steered analysts and shareholders to expect group adjusted operating profit of between £2.7 and £3 billion, down from £3.1 billion in the last financial year, and free cash flow between £1.4 and £1.8 billion, compared to £1.75 billion a year ago. Also, £1.45 billion in share buybacks, funded roughly half and half by organic free cash flow and the sale of the banking business. Tesco won't say anything about dividends until the first half results that are due in October. And finally, we come to safety equipment and hazard detection specialist Halma, which is due to release its full year results to March on Thursday the 12th. Its shares are back to within 10% of 2022's all-time high. Chief Executive Mark Ronchetti gave pretty detailed guidance alongside March's trading update, so there may be as much interest in any outlook for the new financial year as the results from the old one. Note that this will be the first set of results for new Chief Financial Officer Carol Cran, who took the post as of the 1st of April. Mr Ronchetti has already suggested that the past year would see good organic sales growth on a constant currency basis, with a better than expected adjusted operating margin of 21%, despite the negative impact of strength in sterling. On a headline basis, analysts expect for the year just ended 9% growth in sales in 2025 to 2.2 billion, followed by a 6% rise in fiscal 2026 to 2.3 billion. A 15% jump in pre-tax profit to £392 million, with another 9% advance expected in the coming year to £426 million, and an 8% hike in the dividend to 23.4p a share. Now, if that's correct, that forecast means Halma would increase its annual dividend by at least 5% for the 46th consecutive year. Thank you for watching. I hope that you and your families are all keeping well, and I look forward to seeing you again next time.